Here to talk us through the risks and opportunities in this rally, Emily Rubin is a financial advisor at UBS Global Wealth Management. Emily, it's good to have you. So, you probably just heard we were talking about with Tim Seymour, this whole idea of what kind of stock should people be betting on right now? You obviously are not a stock picker. What's your kind of top-level advice to clients these days?
Well, we think that, with the equities having reached highs, only yesterday, I think it was the 47th time the S&P closed at a high. So we think the easy money has been made in stocks. And when we look out a year from now, there may only be another 5 or 10%, but we're still risk on in our portfolios. And we just are advising our clients to use caution and prepare some for volatility and add some protection to their portfolios because we expect some volatility ahead.
Yeah, and you're saying, listen, the idea of investing to protect yourself against inflation is, let's step back and look at what's been going on with the inflation trend. I believe you're in the camp that says, look, things might have peaked in terms of growth, but it's still going to remain high. So paradoxically, you still need to invest that cash. Real yields are something that you guys track quite closely in that regard, right?
Yes, we do think inflation likely peaked in June and will start to normalize, though some of these price increases are likely here to stay, particularly those driven by wage increases. So we think inflation will normalize at a little above 2% in 2022, which is certainly higher than we've seen it in recent years. But in the meantime, with very high inflation and very low interest rates, the real yield on cash is at a historic low. This definitely causes us concern with so much cash on the sidelines. In particular, we have several entrepreneur clients who had recent liquidity events, and we are urging them to help us make a plan with them to put the cash to work because it will be a drag on their returns.
Yeah, so give me an example of what that would look like. So if somebody says, I had this, this business success, I have cash now, and you guys are saying, listen, you're going to be falling behind if you just let that pile up and kind of sit there at a time like this. But at the same time, you're warning about kind of the stock market and maybe gotten a little too far ahead of itself. I'm sure you're not turning around and saying, yeah, but bond yields look like a great deal right now. So where do you go?
Well, it is tough, and everyone is cautious and worried about the market being able to sustain these high levels. Although historically, investing after a market high has actually not been an impediment to future returns. Looking back at data since 1960, the S&P has averaged 11.7% if investing after market highs versus only 11.3% when below the highs. But we suggest that people be cautious, and particularly with these entrepreneur clients that we have who have a lot of risk already in their business, they want a more thoughtful and cautious approach to investing their cash. So for this, we suggest dollar cost averaging in and pulling forward purchases on downside volatility.